Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Katie Gouinlock, portfolio manager at Vanguard. We have Joe Higgins, portfolio manager within global fixed income at Nuveen. Herr, managing director and U.S. CIO with global fixed income, currency, and commodities at Morgan Asset Management. And John Keller, ETF Specialist at Morgan Stanley. We're here to discuss what's driving the narrative in fixed income investing and why active management is more effective for delivering results. It is great to have everyone with us, certainly a lot impacting the fixed income space. Let's kick it off with you, Katie. Let's get your higher level overview of what's happening within the macro environment.
Yeah, absolutely. So, a couple of years ago, you were hearing a lot from us around bonds are back. Now I think the messaging is really like bonds are still extremely relevant, and there are still many, many opportunities for investors. And what's different between now and like a couple of years ago? I think that's really a function of like the continued yield that clients are able to obtain in markets. And so really when I think about like what's compelling and what's resonating with our clients right now, it's really the role that yield is going to play in a portfolio right now in this type of market environment. Vanguard's been talking to clients for a long time about the role of balance and diversification that fixed income will play in a portfolio. But as we continue to be in an environment where we have higher yields, and more uncertainty, quite frankly, in the global macro backdrop, that sort of ballast is becoming increasingly more important, and we're encouraging clients to really think about and lean into their fixed income allocation. The second thing I would say is that higher yields, while there is a lot of rate uncertainty right now, and we do get a lot of questions about that from clients, with higher yields you have sort of the benefit of like, if yields are higher for longer, clients will benefit from that. If yields fall, clients will also benefit to that. And then given just sort of the absolute level of yields, if yields increase from here too, there's a little bit of a buffer for clients. So just generally speaking, we think it's a very attractive time for people to be thinking about how they're allocating their fixed income in their portfolio. And there's never been a better time, quite frankly, in terms of like the type of access investors have. There are many different products. Many of us are all from issuers that are very focused on how do you deliver fixed income to different clients. And so we think it's just quite frankly like a really fantastic time.
Yeah, and we'll get to that towards the end here when we think about portfolio allocation and recommendations that you're making. Joe, from Nuveen's approach, how are you looking at the macro?
We would agree that yields are very, very attractive relative to the risk in the economy. The economy is quite strong, but inflation is slowing. You want to have carry, you want to be invested, you want diversification across nearly all asset classes. Spreads are tight, bonds are rich, but they're rich for a reason, because the consumer is strong, the risk of defaults are low. And the asset class is, to your point as well, on a yield basis and risk basis, probably amongst the most attractive in about 15 years.
Yeah, and Kay, how are you approaching it?
Similar. I think Morgan Asset Management had the similar bonds are back. We've moved on to there's income and fixed income again, but it's the same thing exactly as Joe has said as well. I think the macroeconomic backdrop is relatively strong. You look at corporate earnings, you look at the consumer broadly, you see strength in that. You reference the spreads are tight if you look at high yield spreads in the first percentile, but if you look at yields in high yield, and we think that's what's most important to our clients, what is the actual yield that you're getting? Those are more average if you look at longer periods of time, and that's pretty compelling, really.
Yeah, it certainly is. And from Morgan Stanley's perspective, how are you approaching it when you think about the macro environment and its impact to the ETF space?
Really similar to my three panelists. The environment supports taking risk. Yields are attractive. They've been attractive, I think, as Joe said, probably for a couple of years now. I think what's interesting is parts of the market that were less attractive 2 years ago, even though maybe all-in yields are the same, are less attractive now and vice versa. So I know we'll get into asset allocation later, but before maybe mortgages were not nearly as attractive. I think mortgages probably are more attractive now, and you're seeing that more across the board. More asset allocators are probably moving out of credit that is tighter spread-wise and moving more into say agency mortgage.
I also think it's important to note that you called out capital markets technology and how that's helping the space evolve.
Well, so from an ETF perspective, absolutely. So, I mean, obviously for a successful ETF, you need performance, active ETF, you need performance, you need distribution. But what we find, so we've been in the business, the ETF business for 2 years now. We were very cognizant about building out basketing technology so that we could interact with the capital markets, ETFs being much more capital market tools than, say, mutual funds are. So we've been very cognizant about building out a process and technology, proprietary technology, such that market makers know how they're going to interact with our funds, how they're going to redeem with our funds. Clients that want to do really large trades, really large model allocation trades, understand that there's a process whereby the street knows how to interact with us. Spreads are going to be tight on our ETFs because the creation redemption process is well known to the market participants, and it's effective.
Okay, why is the narrative of active versus passive really a big factor within the fixed income space? Is it because of its sophistication and its size? Why are managers leaning towards active fixed income, whether it's performance related or just because of the size of the market?
Yeah, it's a great question. I think first on the topic of the size of the market, the bond market is more than an order of magnitude larger than the stock market. So we're talking about something like 3 million individual tickers that are available. And for any given benchmark, a common one in our industry is the Bloomberg Barclays Ag. It only captures about half of the investable bond market. So an approach that's passive is leaving off whole swaths of the bond market. So high yield, for example, is not included in one of the typical passive benchmarks. There's a very low representation of securitized credit, for example, so asset-backed securities. A lot of opportunities that we find to add value, you can't access simply through the benchmark.
Yeah, and even besides the ETF wrapper itself, it's underlyings, right? I mean, you're looking at different durations, different liquidity profiles. It is more complex than, let's call it, an equity ETF and how that trades.
Yeah, that's very fair indeed. So picking up on your very good point on active, right now when spreads are tight and all sectors are pretty tight is when active management can really shine, right? Because we are doing and we're recommending people do underlying trades up in quality, or you sometimes just give a little bit up in a basis point or two to get a much more attractive security that's less volatile over time going forward. One of the keys of active management is to reposition during good times when you don't have to give very much to get a much more stable portfolio going forward. If you're passive, it can have a role, certainly, but you're exposed to whoever has been issuing a lot in the index. You're literally taking along for that ride with whatever companies or areas came to market a lot, which is not always the best performing going forward.
Yeah, which is interesting because we could potentially be at an inflection point when you think about the macro, whether it's the Fed, policy across a number of issues. Katie, you also call out ETF liquidity specifically within the fixed income space.
Yeah, I think, ETFs have been enormously transformative. Everything that we've talked about in terms of just how large the fixed income market is, the number of CUSIPs, the number of different sectors within the space, ETFs have brought transparency and centralized liquidity to that. And I think that's really why they've been as successful as they have in the last several years in terms of investors, quite frankly, adopting fixed income more broadly. The simple way I think about that is you take all these CUSIPs or individual bonds, and so you package them into this one equity-like security, and that provides enormous transparency, but also centralization of liquidity to a single source, and it makes it very, very easy for clients who previously might have had to navigate trading an individual bond or a little bit of uncertainty, really to just kind of with a simple equity trade get exposure to a very different asset class.
Well, the fact of the matter is to replicate those type of trades, not only does it require a level of sophistication, but the cost. You can't compete with it if you're trying to mimic portfolios that professional managers are running.
Yeah, absolutely. The benefit is in that centralized liquidity, often what you're actually doing is you're producing a portfolio that's going to trade with a bid-ask spread that is trading well inside of actually the underlying constituents that you're getting access to. And you're doing that very quickly, and you have the ability to do that real time. And so that's enormously powerful. And then, once your trade is done, it's really up to the manager at that point to handle the complexity of delivering that exposure to you behind the scenes, whether or not, we've talked a little bit about index versus active. And we have a big franchise in sort of both of those circumstances. But I think regardless of it, the power of the ETF still really holds, whether or not I'm trying to get exposure to a new active strategy that a manager is bringing to market, or whether or not I'm simply trying to invest in the U.S. ag, and I want to make sure that the manager who's on top of that is able to sample and effectively reproduce the returns of the benchmark.
Yeah. Well, does it help to, Joe, does it help to diversify offerings when you have active management versus just, relying on the index to do the work for you? But it kind of helps to differentiate the products as well.
It definitely does. It definitely does. I mean, obviously, in the ETF space and in asset management, passive is dominated in the ETF space. Right. We're starting to see active ETFs really grow in scale. It's not a hot take. That's going to continue. And I think it's driven by a couple of things. One, the ETF demystification is happening in active ETFs right now. It happened in passive ETFs before. Vanguard was one of the leaders in that space. But we still spend a lot of time explaining to active investors, especially active fixed income investors that are in mutual funds, what the ETF wrapper is all about and what it brings to the table and why, in our opinion, it's a superior wrapper. The second piece is really the wealth management business is changing. It's becoming more of a model-driven business. Yeah. We have less the financial advisors, the PM. Now it's becoming a centralized process where a centralized model. Those models are becoming increasingly ETFs, and we expect that to continue. That's a trend that's not going to stop.
I would also think that clients are looking for more sophisticated types of products as well, while they're looking to derive yield. I mean, that's one of the reasons why you're seeing growth in alt investments as an example. So perhaps they're looking to fixed income and active management to get more sophisticated type of products that might not be so plain vanilla.
I think that's an absolutely fair comment, and I would add maybe to one point that Katie and John made, the transparency of the ETF is very compelling to people. So what people like about owning an individual bond is, I bought this bond and I know that it's going to give me this coupon and this maturity. When you look at trying to replicate the ag with more than 13,000 bonds, that's almost impossible for an individual investor to do on his or her own. But the benefit of the ETF wrapper is you can see daily liquidity, actually intraday liquidity, as Katie referenced, and daily transparency on every single holding we have on the ETFs that we're running.
Yeah, and the time that we have left, I'm going to ask you this question, Kay, in terms of strategy and how you're thinking about positioning within one's portfolio, because you're also looking at currency and commodities as well. Where are the attractive areas?
Yeah. So we think, maybe picking up on Katie's original comments, we think it's back to basics in fixed income. We've got income, and we like to call it the ABCs. And by that I mean anything but cash. So we're looking, as Joe mentioned earlier, we're looking to pick up yield. Where can you find it? You can find it in securitized credit. You can find it in high yield credit. So opportunities, the ag's yielding about 5%, and we find a whole host of opportunities in consumer and corporate credit where we can pick up additional incremental yield for investors, and that's meaningful to retirees, to our broader client base.
Yeah, and you had actually picked, John, you had mentioned a couple of call-outs within the fixed income space that you think are more attractive than others. What would you be avoiding at this point?
Yeah, I think that when spreads are tight, you want to go up in quality, as I said a little bit earlier. So there's probably a lot more dispersion to come in, say, deeper CCC type loans, for example. At some point, a lot of issuers have termed out over a number of years. They refinanced out. But the dicier issuers, if you will have to come to market. And we could see more, even though the economy is relatively sanguine, we could see a lot more vol this year. When spreads are very tight, that's a prescription typically for volatility. Obviously, there's a lot going on in the world. So we think you should have some dry powder, be ready to monetize that volatility with other higher quality sectors.
It's so interesting. Over the past couple of years, we've been thinking about the impact of the Fed. We were supposed to get 6 to 7 rate cuts. It never happened. We saw the performance in the markets in 2024. They were exceptional. And now we're thinking a little bit higher interest rates for longer, and perhaps not as many rate cuts as expected. The market has been pretty resilient, despite some of the signals that we're seeing from fixed income and credit. And I as I mentioned before, alts are starting to get a little bit crowded as well. It's quite remarkable how the market's been digesting a lot of these outliers.
It is, and where is the liquidity coming from? Well, it's been coming obviously from a lot of flows into the U.S. Globally, it's been coming from deficit spending. All these things help to drive liquidity, and of course the job market is good, and there's a lot of earnings being had. Liquidity could ebb and flow a bit depending upon what happens next. Are we going to get tariffs first before a tax cut, or vice versa? All these things can really create some vol.
And that's a good point that you make. I mean, liquidity, it just doesn't cash in the system. It's derived from other means as well, credit being an example. So, Katie, when you're thinking about this backdrop, what areas look attractive when you're thinking about allocating in one's portfolio?
Yeah, so when you're thinking about the space I'm in, I'm trying to consistently deliver the return of the index through a variety of market cycles. And that takes a team that has had experience managing through a lot of that volatility, right? Fixed income indexing is inherently a little bit more active than perhaps its equivalent on the equity side, in that given the breadth of the benchmark, it's not efficient nor is it necessary to own every security. And so really, when we have the backdrop of market volatility, we're focused on how do we best sample in order to continue to deliver that benchmark very consistently over time. You know, what does that look like? That looks like controlling major risk factors. There's been a lot of rates volatility, for example. It's paying attention to how we're positioned from a duration and a key rate duration perspective in the portfolio. It's paying attention to credit and making sure that we're leveraging our credit research team to really help us understand how we inform that sampling process. So there's a lot that goes under the hood. It's I would say it's a very sophisticated process. It's a lot of what you would use to deliver in an active strategy, but we're trying to deliver beta instead of alpha, quite frankly. So.
Yeah, John, you know what, Katie makes a great point when she mentioned that a lot of investors haven't traded or have invested through a prolonged period of volatility, right? I mean, not really since the financial crisis. I mean, you know, it was a blip on the radar for the most part when you look at it from a historical perspective with COVID. And there was great opportunities if you stayed within the market or you know, took advantage of the volatility we saw. But that also helps to make the case for ETFs. There's a generation of investors who have not really, you know, experienced their money down for you know, a number of months or quarters. I mean, the cycles are just so quick now.
We ran a study recently, and we're seeing increased periods of volatility, but much shorter.
Right.
And so I would completely agree with you. So you've been rewarded to put on risk very quickly when we had bouts of volatility. We'll see if that continues going forward. To your point, a lot of these investors have not seen a 2008 or a 2000 when bank loans traded at 50, AA CLO tranches traded in single digits. These are all being packaged into ETFs and have been packaged into ETFs over time. Some of them are tried and tested. Some of them aren't. We'll see how deep the volatility periods are going forward, how long lasting they are, and if they have an impact on these assets that may not have been, at least with the current investors, through that type of volatility.
I find that interesting to see how, I mean, not that we're wishing for it, but to see how investors would respond to something where the volatility isn't half a market session. I mean, look at, DeepSeek as an example. That could have been quite impactful if you were to look at that type of trade, 15, 20 years ago, and the impact it would have had on the space. And essentially reversed itself in, half a session or one session. So, Kay, when you're thinking about what are the catalysts here, whether it's to break out to new highs with the market overall or send some shock waves, what are the catalysts that you're really going to be looking at?
A couple of things. I mean, at its essence, investing in fixed income, it's very important to understand the macroeconomic dynamic.
Right.
And we've touched on this here, and I think, you mentioned that broadly, the U.S. economy is strong. Maybe U.S. economic growth continues to be strong. Corporate growth continues to be very solid, as we've seen in this season's quarterly earnings. I think the volatility and the potential for volatility arise from a couple of things. You referenced the Fed yourself, Jill, and what the expectation is on what the Fed's going to do. And I think a reminder that the Fed, our central bank, focuses on a dual mandate, which is unlike any other central bank. So our central bank is looking at both employment as well as stable prices. And I think that's the balance this year. We have seen, for the most part broadly, a moderation in personal consumption expenditures, so the Fed's preferred metric of inflation. And we've seen relatively solid economic or employment growth, some not as broad base. We've seen some declines in quit rates, which tend to precede declines or weakness in unemployment rate. So I think that's kind of the balance here. The Fed achieved the almost impossible in a soft landing. We kind of sit here going along it in that, but I think you've got a risk, as you mentioned earlier. You've got the potential for tariffs, the potential impact for DOGE, and the mismatch on a timing for that could absolutely create more volatility, as I think Katie mentioned.
Yep, and Katie, I mean, it all comes down to execution at the end of the day on how these policies. It's one thing to discuss a policy, but to execute and move forward with it is something else entirely. So it's not as if there's really an operating roadmap just yet.
No, I think like the only thing that's certain is that it's going to be highly uncertain. And really, like, we are focused on trying to encourage our clients to control what they can, right? What can you control? Like, you can control cost, whether or not that's active or index. Cost is a very big driver of your long-term outcome. It preserves return in an environment where you're delivering an index, and when you're delivering an active fund, it actually allows you to get higher reward while taking less risk, right? You can control your asset allocation, and then you can control having the discipline to stick with it. And to the point that has been raised here around many investors in ETFs have not maybe seen a market cycle, sort of adherence to that long-term perspective is going to be really critical for investors having like the right outcome over time.
All right, we appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.